Tomorrow morning, American and Iranian diplomats sit down in Oman. The entire Middle East is holding its breath. And whether they shake hands or walk away could determine what you pay for gasoline this summer. Here's what I'm breaking down today. First, those nuclear talks and why 6 countries are pressuring both sides. Second, the wildest natural gas week in years. Third, a mega merger that just reshaped American oil. And fourth, what falling rig counts and rising job cuts actually mean for energy prices. All of it connects to your wallet. I'm Mark Roach, petroleum engineer, 30 years making deals in this business. This is FutureWise Energy. Let's start with the numbers. Oil sitting at $64.38 a barrel today. That's West Texas Intermediate, which is the main American benchmark. A week ago, it spiked above $70 on fears temporarily of U.S. military action against Iran, but it's back down because talks are happening. That's how sensitive this market is right now. Natural gas, $4.40 per unit of energy. 1 week ago, it was $7.18 on average. And on January 27th, during the winter storm Fern, it hit $17.19 on average. That's a 75% collapse from that peak to this week. Now, let me explain tomorrow's meeting. In Muscat, Oman, beautiful place, U.S. envoy Steve Witkoff will sit down with Iranian Foreign Minister Abbas Araghchi. This almost didn't happen. Iran changed the location from Istanbul to Oman at the last minute. The White House, well, it nearly canceled, and then 9 countries stepped in and pressured both sides to keep talking. Now, here's the fundamental problem. The U.S. wants Iran to stop enriching uranium and killing people, limit its missiles, and cut ties with armed groups across the region. Iran says it'll only discuss nuclear issues. Well, missiles and regional allies may be off the table, and that's a huge gap. One Iranian official told Reuters that the missile program is a red line, more important than uranium enrichment itself. So why does this matter to you? Well, about 20% of the world's oil flows through the Strait of Hormuz. That's right on Iran's coast. And it's only 21 miles wide. And there's a lot of traffic that goes through there that could be compromised if Iran wants to start trouble. So this week, Iranian gunboats have already approached some U.S. flagged oil tankers in the strait. The U.S. shot down an Iranian drone approaching an aircraft carrier. Now, if the talks collapse and either side escalates this, oil could spike back above $70, $80, even $90 temporarily. And when oil spikes, eventually it does show up in your price at the pump. The entire Middle East is on edge. Saudi Crown Prince Mohammed bin Salman called Iran's president and promised Saudi's airspace won't be used for attacks. The UAE made the same pledge. The UAE's president even canceled a state visit to Japan just earlier to focus on this crisis. Qatar, Turkey, and Egypt jointly presented a framework for dialogue. Oman, which is a very friendly country to the United States, well, they're hosting and they're also mediating this meeting. Kuwait gave assurances as well. Now, that's 6 countries that are actually pressuring both sides, and nobody wants a war in their backyard. Now let's talk about natural gas and why your heating bill may just look a little bit scary from this month or maybe even last month. Winter Storm Fern knocked out about 15% of U.S. gas production. We normally produce around 117 billion cubic feet per day. The storm dropped us down to about 102. Meanwhile, demand spiked to 121 billion cubic feet per day. So that math doesn't work. That's why prices exploded. Natural gas producers who had locked in prices beforehand, well, they made fortunes. That's what happens with trading. Hedging activity surged 6 times higher during this spike. So those companies who weren't hedged, or those parties who were trading this gas, they scrambled. And so now production's recovering to about 112 billion cubic feet per day. We've got warmer weather, and which hits the forecast, and so the prices have collapsed 75% just since last week. Here's the drilling picture. Total U.S. rigs right now are running at 546. That's 41 fewer than last year. Now, historically, these numbers have been over 2,000 or 2,500 in good times. So today they're running at 546, and that's even down 41 from last year at this time. Now, of those 546, 411 of those are drilling for oil in the United States, and that's down 68 rigs from last year. The Permian Basin, which is in West Texas and New Mexico, has about 242 rigs working right now, and that's down about 61 from last year. Gas rigs, well, they're actually up about 27 rigs from last year to 125 rigs running this week. And that's because companies are chasing natural gas tied to liquefied natural gas, LNG exports, and data center electricity demand, which is growing here in the U.S. U.S. oil production sits at about 13.7 million barrels per day, the best estimates are indicating right now. That's about 166,000 barrels a day below the all-time record high, but that's still near plateau levels. The industry's doing more with less, longer horizontal wells, better technology, tighter operations, but at $64 oil, companies aren't rushing to drill new wells. The economics are marginal. That brings us to corporate news. Devon Energy and Coterra Energy announced an all-stock merger on February 2nd. And this creates one of America's largest oil and gas producers, dominant in the Delaware Basin and the Anadarko regions. Delaware Basin is in West Texas and New Mexico. The region is mostly in Oklahoma. It's part of a bigger trend of this merger between these two companies as part of a larger trend. Companies are combining to cut cost, low oil prices. They just don't leave any room for error. ConocoPhillips is one of America's largest producers, and they just announced a $1 billion cost-cutting plan after missing earnings expectations. Their average realized price fell 19% to $42.46 per barrel. They're building on $1 billion in synergies from buying Marathon Oil. So when you see costs cut at this scale, it often means, unfortunately, fewer jobs, less drilling, and eventually less supply down the road. And that creates instability geopolitically and also in our prices that we pay for things here in the United States. Now, Venezuela remains in this stuck position. Wells across their main field, the Arenco Belt, are being shut in because of these export disruptions. The heaviest crude wells, well, they're shutting those in first. And major oil companies still call the country uninvestable without sweeping reforms. Production recovery remains likely years away, despite the headlines. So here's the bottom line. Energy markets are caught between geopolitics, weather chaos, and companies trying to survive lower oil prices. OPEC just extended its production pause through March, holding back supply to support prices. But if the market still faces a surplus of nearly 4 million barrels per day, according to the IEA, when diplomats meet in Oman tomorrow, they're not just negotiating nuclear programs, they're negotiating the stability of global energy. Watch what happens. If talks fail, expect oil to jump. If they succeed, expect calm. Either way, you'll feel it at the pump. I'm Mark Roach. This is FutureWise Energy. Pay attention to the structure, to the fundamentals of how things work before you throw in your 2 cents, your opinion. Listen and understand how these dynamics are working, and that'll help make you wise.